a $4,543 gold price with a 10-year yield at 4.42%. Those two numbers rarely sit together quietly. Gold opened at $4,597 and dropped fast. The range today prints $4,510 to $4,610. That spread matters right now. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Now, yields are rising while gold holds structure. Let's get straight into it. The Federal Reserve holds rates at 3.50% to 3.75%. Three members dissent on future cuts language. That detail shifts expectations immediately. The two-year Treasury yield pushes above 3.95%. Markets now price 0 cuts through 2026. That is a complete reversal from 6 months ago. The timing is what deserves scrutiny, not the hold itself. The timing. Think about what that sequence actually means. A hawkish Fed usually strengthens the dollar immediately, yet the dollar index sits at 98.60, below the 100 psychological level. That divergence is not normal. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today. Federal Reserve policy decision. Rates unchanged at 3.50% to 3.75%. 3 dissents on forward guidance language. Effective immediately following the latest FOMC meeting. This follows a market previously pricing 3 cuts in 2026, now pricing none, with a 1 in 3 probability of a hike by April 2027. The unusual detail is the dissent count, not 1, 3. That signals internal disagreement on easing. The timing is what deserves scrutiny, not the decision itself, the timing. Markets adjust rapidly when consensus breaks. Think about what that sequence actually means. If internal Fed disagreement rises, policy clarity drops. If clarity drops, volatility rises. Which asset benefits from that environment? The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. A hawkish Fed failing to push DXY above 100 is rare. The last similar divergence preceded major gold rallies. The data is already telling you something. Let's build it out. Now let's build the full picture because Federal Reserve policy does not exist in a vacuum. The U.S. Treasury yield curve data has updated. The 10-year yield prints 4.42% from U.S. Treasury data. The 2-year yield crosses 3.95% from Federal Reserve economic data. The DXY index sits at 98.60 from ICE Futures US. That is within a 52-week range of 95.55 to 101.98. Year-to-date flat despite hawkish policy signals. That is not typical behavior. The comparison matters. In prior cycles, similar yield moves pushed DXY above 102. This time, it fails to break 100. That is the deviation. Now connect that to gold. Gold spot prints $4,543 from COMEX data. Shanghai Gold prints $4,569 from Shanghai Gold Exchange. That creates a 2478 premium, roughly plus 0.55%. That premium persists despite price pullback. The rate of physical demand decline is not accelerating. It is stabilizing. The data is doing the talking. The ones who have been called early for tracking physical premiums, they are not saying much right now. And here is what makes that picture even harder to ignore. The U.S. fiscal deficit approaches $1.9 trillion for fiscal year 2026. U.S. Treasury data confirms rising debt servicing costs. Those costs now rival defense spending levels. At the same time, yields continue rising. That creates pressure on refinancing costs. That is not a contradiction. That is the setup. A Fed that hikes too aggressively increases fiscal strain. A Fed that pauses allows inflation persistence. Both paths support long-term gold structure. And before anyone takes that as a green light, setups can take a long time to resolve. What this tells you is the structural picture. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Here is the number most people are not talking about. $1.9 trillion annual deficit. That number constrains monetary policy. Now, Iran and the Strait of Hormuz, because this is no longer a backdrop, it is the primary variable. Approximately 21 million barrels per day pass through the Strait of Hormuz. That data comes from the U.S. Energy Information Administration. Oil prices react immediately to any disruption signals. Current geopolitical tension keeps tanker routes restricted. No confirmed nuclear deal between the U.S. and Iran. That maintains supply uncertainty. Higher oil prices push inflation expectations higher. That forces central banks into tighter policy stances. That increases yields. That pressures gold short term. Markets are still pricing contained geopolitical escalation. Look at oil volatility and tell me what probability you assign to that. When markets start pricing actual supply disruption risk, oil reprices higher. Inflation reprices higher. Rate cuts delay further. That is the historical pattern. Every time major oil choke points tighten, inflation expectations surge. It has not been different yet. Now gold Western spot at 4,543, Shanghai price at 4,569, 24.78 premium remains. Short-term picture is compressed and unclear. Gold holds above $4,500 support, but fails to break above $4,600 resistance. That range defines current structure. If yields continue rising toward 4.60%, gold tests $4,500 again. If DXY breaks below 98, gold pushes toward $4,800. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on the lower time frames right now. I cannot tell you what gold does tomorrow. Nobody can. If you think you know, good for you. Current environment shows conflicting macro signals. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that costs you. So let's run both. The bear case is real. 10-year yield at 4.42% increases opportunity cost for gold. Federal Reserve signals zero cuts through 2026. Oil-driven inflation delays easing cycles globally. The bull case is equally real. DXY fails to break above 100 despite hawkish policy. Central banks continue gold accumulation globally. Shanghai premium persists, showing steady physical demand. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything shown today points to one thing. Structural support remains while macro pressure caps price. The ceiling is geopolitical. The floor is structural. Do not take my word for it. Verify every number I gave you today. Check the data yourself. Federal Reserve economic data, U.S. Treasury, Shanghai Gold Exchange, logic over hype. Always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0 out.